Hello and welcome to the India View with me, Tanvir Gill. My guest today on the show is a man who is one of the most well-known and respected emerging market investors. After having managed nearly $50 billion at Wantable Asset Management as CIO, Rajiv Jain has turned an entrepreneur with GQG Partners. The Goldman Sachs GQG Partners EM Strategy Fund is his latest offering to the market, which has already garnered $1.5 billion in assets under management. After nearly 3 years post the market mayhem in September 2013, I have Rajiv joining me from Florida once again to make sense of the Indian market and share his outlook thereof. Rajiv, it's great to have you on the show. Thanks very much for taking out the time. First up, what was your initial reaction to the budget, where the focus was clearly on boosting rural demand and addressing the issues of corruption and black money?
Yeah, I think there was, as a reaction after the budget reflected, there was a lot of concern going into the budget because there were a lot of rumors about capital gains tax and so on and so forth. So there was a sort of a relief rally. But I think it was sort of middle of the path budget, nothing controversial. Reasonable budget, I would say, not something you can hang your hat on in any big way. There wasn't any strong statement, except, as I said, the election's coming up, so it seemed to be shifting in the direction where my feeling is you're going to see more populist measures coming through, from this administration, and I think the budget reflected that.
Okay, having said that, in that case, characterize the rally that we've seen in Jan. I mean, we are beyond the pre-demonetization levels. We are talking record highs on the markets once again. This has been the strongest move, by the way, ahead of a budget and post that, and a very confident-looking market into the start of any calendar year. So how are you really looking at this move? The mid-cap index is already at record highs. Likewise for the small-cap index, the Nifty is likely to join them soon. What does this rally reflect?
Yeah, I think the key issue is there's a relief rally that, the growth is going to come back. The question really is, if you go back to pre-demonetization, let's say October or before October, are we looking at any acceleration of growth? And my perception is that that's unlikely to happen. So there's a relief rally coming from, the effect of demonetization are not as bad as everybody thought in for first half of November with people lining up, that sort of stuff. So I think it goes back to, but the question really is, what's beyond the demonetization and effects of that? And that's where I think my longer term concerns are from corporate earnings perspective. So one of the things I would like to highlight is there's a difference between what's good for the country and what's good for equity markets. They're not always the same, right? And if you look at the big part of the index as such in India, it's the earnings growth, incremental growth of earnings, 2/3 over next year, for example, will be coming from cyclical sectors, right? Banks is a big part of the incremental earnings growth. Now in banks, we know what the situation is outside a few banks, or some of the metals, the energy, and those sort of things because of the recovery in commodity prices. But broadly speaking, corporate earnings, I believe, will struggle to come through. The yield curve is very, very flat, which is interesting to note in the Indian context. And even on the banking side, NPLs are pretty steep. I mean, you're looking at 5+ years now where NPLs have been creeping up, right? So I think this is an environment where you have to be ultra careful in terms of picking spots. And I think that is the key issue, especially if you take a sort of 2-3 year view.
Right, but Raji, from being a big bull, you've turned cautious on India and are citing valuations as a key concern. But many on the street feel that 15 to 16 times forward earnings is really, adjusting at the upper end of the fair band that India has largely traded in traditionally. What's your own opinion?
That's where the issue I have is that, let me put it differently. If your head is in the freezer and your foot is in the oven, right? Your average temperature is fine, but you might be dead, right? So, average is not telling you anything because you get Tata Motors at 9 times earnings and Hindustan Unilever at 37 times earnings, right? But there's going to be a big difference between what you're going to buy. So the average is a little bit misleading at this point because historically, the big component of the index were also delivering very good defensive growth. And that's where engine is beginning to misfire a little bit.
Okay, let's talk about sectors and stocks because stock picking is where your heart lies. What's the view on banks, PSU banks, private banks? Do you think we've seen the bottom of the asset quality deterioration cycle? You hold HDFC Bank. Largely banks have led and have been the flag bearers of this last 10% move on the index. Will the leadership continue?
Yeah, look, I think if you look at the public sector banks, the NPLs are, if they stabilize, who knows? Because we don't know the true longer term effects of demonetization at this point. It's too early. How much pain has been inflicted on the SMEs, what the NPLs is going to be, don't know, right? Nobody knows. So though the public sector banks are undercapitalized, they need to be capitalized further. And despite the fact that incremental NPLs might be slowing down, it's difficult to make a positive case, why things would sort of, revert back and setting sort of normalcy. On the private sector banks, if you look at if the credit growth is going to be, let's say, mid to high single digits, and some of these banks are, even HDFC Bank, are reasonable size and scale now, even if they grow 2 times credit growth, right? And so they gain market share against the others, which is historical norm, you get to low double digits. It's difficult to see how some of these will grow beyond. Now, they could still have IndusInd Bank or Kotak and, individual banks do fine. But broadly speaking, whether it's like ICICI, HDFC Bank, I think the growth in general for HDFC Bank also should be slower than historical norms suggest, which is not the end of the world at all, by the way, for the size and scales. I mean, it's a large, $35, $40 billion bank. That's not a small bank at all. That's perfectly fine. But the growth expectations have to come down because HDFC Bank is still at 21 times earnings, right? And if you look at Axis Bank's numbers, I mean, the NPLs, if you include the restructured loans, they're still pretty elevated, right? And why would all of a sudden they come down? The incremental increase in the NPLs probably would not continue the same pace, but that's a different thing than saying, oh, they're going to start coming down, right? So I think that's what I'm saying. It is a time to be a little more careful about overall exposure. So we're still at 10%, but we're sort of struggling to have large exposure at these valuations.
What really surprised me is that how you have completely sold out, booked out, exited your long-term holdings in HUL and ITC. You've sold out from what is traditionally seen as the bread and butter sector for investment in India. I mean, the consumption theme lies at the very core of India's growth story. And when foreign investors and fund managers such as yourself are looking at India, they blindly bet on the consumption theme. So why don't you like consumer stocks anymore?
Yeah, because I mean, again, I'm taking a much more global perspective and what the valuations are and what you're paying for that. So if you look at Hindustan Unilever, very well-run company, no question about it. But there's a lot of money which seems to be hiding, especially foreign investors, by the way, which seems to be hiding in that area. But if you look at, as I said, the earnings growth, the volume growth, and the effect of Patanjali now is having on these names, I think the markets are underestimating that impact because and the reason is simply that some of these companies have been very aggressive on margin expansion, which is creating room for some of the other players to come in. I mean, you can't really have margin expansion forever when the volume growth is now down to literally nothing or low single digits, right? I mean, think about it this way. Why does ITC has much higher margins than some of the local, regional areas in terms of, just tobacco? Number one. Number two, the tax is still lower than that, lower in India than than regional comparisons. And then now you have contraband, which is almost 25% of the market from about 5% around 10, 12 years ago, right? So there's a fundamental problem. And on ITC case, there's a change in management also, by the way, which can be, can also lead to some transition in the short run. I won't be worried about long term, but you're paying 28 times earnings for a business which for the last 5 years, by the way, now if you look back, is growing at essentially 10%. So from a global investor perspective, if you sort of think through this, you're paying 27, 28 times earnings for 10% thereabouts EPS growth, right? If you adjust for inflation, which is what I would do, you're getting essentially 5 to 6% earnings per share growth at 27, 20 times earnings. Those sort of numbers are difficult to make money on a long-term basis. So why wouldn't I buy? I mean, let me give you one comparison on a global basis. You could buy Facebook, which had massive growth at 21 times expected earnings, right? Visa, MasterCard are 21, 22 times expected earnings. So I think if you look at a global basis, it's difficult to justify owning ITC. And as you know, we used to own it when it was growing at close to 20% at sort of mid-teen earnings. And let's not forget, ITC has traded at 10, 12, 15 times earnings over its long history.
But Rajiv, ITC is trading around record highs, and the contra view there is it is a diversified business model. You have FMCG, hotels, cigarettes. They're balancing it out in terms of giving that earnings push. And add to that, ITC trades at a discount to its peers. So if you're looking at the consumption basket, this one, despite individually looking more expensive, on a relative basis, actually is undervalued within the consumption basket.
Yeah, well, okay, so the fact of the matter is they're not making money anywhere else, right? I mean, hotels that make money, it's a low return business. I don't think anybody would pay 27 times for a hotel business, right? The consumer goods as such of FMCG, well, they're not making any money, so you can pay price to sales or something like that, but that's just a fact. So essentially the earnings growth, or earnings for that matter, are coming from tobacco, right? So that's what you're paying for. Nobody's going to buy ITC for any other business. We can justify it for that reason, but you're not going to buy it because of that, right? It looks cheaper, as I said, it looks cheaper relative to other consumer staples. And therein lies the problem. It's like going back to .com. What led to the biggest losses was, well, Tiscali in Italy was selling at 200 times earnings, so 100 times is cheaper. Well, guess what? Both of them collapsed. So if you take a 5-year view, with the increasing contraband, and by the way, if you look at ITC's earnings growth, margin expansion has been from there. We're making mid-20s margins, operating margins, now then high 30s margin, right? So unless you expect margins to keep continuing this rate for the foreseeable future, I think it's a valuation call, right? We can argue all day long, but if there's any sort of normalization on a 5-year basis, I have no idea what's going to happen next 12 months, by the way. If you have any sort of normalization 4 to 5-year basis, and the question really is, why have these stable names, and that's not only in India, by the way. You look at Unilever Indonesia, 45 times earnings. Earnings growth is down to 12%, but 45 times earnings. So there's a massive re-rating in these names, which obviously I benefit from, but I think it's time to move on into other areas.
Okay, moving on, you're off IT as well. Information technology as a sector, I mean, you don't fancy it anymore. Automation and regulatory risks in the United States, are those the two factors that worry you most, which is why you've exited?
Yeah, I think jury is out in terms of the regulatory or the legislative environment in the U.S. We don't know yet, because this could be a lot of talk and not much comes out of it. So difficult to sort of handicap that in any shape or form. I do feel there's a structural slowdown because of, you mentioned some of them, automation and so on and so forth. And these companies still obviously have linear models, which is now beginning to take a toll. They're in management positions in a bunch of them. I mean, Infosys had one, now TCS is having one. And I think the markets have been pretty smart about derating these names. So I think it's a little more difficult to call in any shape or form. We don't have any exposure because it's difficult to call. I would like to have certainty. So the valuation is not bad. It doesn't look bad, but I think the earnings growth picture from here could be a little more tricky. Especially in light of the regulatory risk that is increasing now in US.
So simply put, you see an earnings risk for bellwether companies such as Infosys and TCS going forward.
Yeah, look, I think if there's a true legislative change in the US, there could be earnings risk here, no question about it, right? And automation is beginning to sort of erode. I mean, look at the amount of fixed contract that Infosys is taking versus last 10 years, right? Taking fixed price contracts is usually a pretty good indicator of how the companies are pricing some of these things in, right? And that is a risky proposition if you look at historically. So that itself is a sign. Number two, you look at the number of people they have to hire and the churn on an every quarter basis, not in percentage terms, but just the absolute numbers. These are all the signs that I would look for if I'm a long-term investor. It doesn't mean you buy or sell tomorrow. It has no relevance tomorrow. So, which is why I'm saying there's not enough certainty for somebody to say, okay, we need to own these tomorrow.
Right, Rajiv. So IT, pharma, consumers, that's a space that you're not looking at from a value perspective in India. What are you bullish on when it comes to the India story? Because like I said, you've sold out of traditionally high conviction sectors, almost default sectors that fund managers look at when they're investing in India. So where is the opportunity for you?
Yeah, so I think, well, as you said, that hence our exposure to India has gone down quite sharply. We don't have much exposure directly the oil and marketing companies as such, or the metals and so on and so forth. I do feel that some of the cyclicals are interesting. We're still doing work because they've been beaten down quite a bit, and Tata Motors is a perfect example. Last year was really cheap. It looks very attractive. Indigo is a different animal. I mean, I think they'll continue to gain market share in an industry which is struggling globally, but consolidation will continue to happen, and valuation is still pretty reasonable for a company which is, if you look at it from a cost matrix perspective globally, it is one of the lowest cost providers as such. But on the oil and Reliance, I must say, is very intriguing because you're not paying anything for the telecom at this point, and the core business. I mean, they're really good operators, but that's also pretty intriguing name on its own. So it's very, very stock specific. It's difficult to make a broad case for any sector.
Okay, then let's talk about Reliance Industries. A 5-year chart of the stock will show that it's given no returns to investors. It's been a bit of a dud. I could be wearing a blindfold and know the range in which Reliance would move. What will the telecom story mean for Reliance's earnings in the wake of the potential Idea-Vodafone merger? What would it really mean for the stock?
Well, as I said, it's very, very intriguing, is the right word to say, because the core business is doing well. The gas side, it's you can write it off. There's not much happening there at this point. The telecom side, the consolidation has begun to happen, right? So you ultimately led with basically 3 players at best, and that usually is a good sign. It's a beginning of more consolidation, and I think the players who are left should be doing better. Obviously, Reliance also has massive headway on the cable side, which is very intriguing. As I said, so I don't want to make a very bullish case at this point, but it's very interesting name on its own. I'm just giving an example of the differentiation between the steady eddies where I had a lot of exposure to, but I just find it difficult to justify owning because the returns, I don't see how you're going to make money. On the other side, there's things which are a little more complex, have not been good investment the last few years, but things are beginning to change. So you're asking me where it's more interesting to look at, where I'm spending time on. I'm just giving you that perspective.
Sure. You also mentioned Tata Motors. Yes, valuations are supportive. They're cheap, reasonable. But there's concern about JLR sales growth slowing down, and the India business continues to be a drag. What's the outlook here?
No. So I think if you look at the negative is the India business for Tata Motors, right? So I think if they separate that, the stock is going to go meaningfully higher, right? No question about it. I think they've done a good job on the JLR as well as Land Rover. Now, Land Rover in the short run, obviously, I think there's a model transition coming up. But if you look at the premium side on the automotive space globally, all of them are cheap. So not just Tata Motors, everybody's cheap. BMW, Daimler, all of them are cheap. Number one. Number two is the capital intensity of the automotive space in general has been going down over the longer run. Okay. Number three, if you look at Tata Motors, they're selling 600,000 units. It's tiny. So to get volume growth on that number, and they've actually done a very good job in terms of the freshening of the whole the lineup. So I do feel that they should be it'll slow down, but you're not exactly paying for 20% kind of growth anyways. I think this business can compound at double digits and is still pretty attractively valued. So it's a lower risk proposition to get double digit returns in dollar terms, by the way, which is what I seek. And that's sort of the base case for Tata Motors. And I think the recent transitions of this whole, the mess that has been at the holding company level in Tata is actually a good thing, I believe, because it'll bring more sunshine, right? So net, I would argue that's a good thing what is happening. These sort of shakeups tend to bring up better things, not worse things.
But could you explain why such a strong conviction on a stock like Indigo, which has done really well? So I'm not taking away from that. But in an otherwise distressed sector, why do you have such a strong investment position in Indigo?
Look, I think sometimes you find very intriguing names in industries which are struggling, right? You don't always make money in industries which are booming. In fact, a lot of times because it's booming, the returns go down because too much competition comes in, right? So in case of Indigo, we don't own any other airline anywhere else. We've looked at in Europe, we looked at in US. So that's sort of on its own merits. It's standing on its own merit, which makes it so intriguing.
Rajiv, last couple of questions then. What would make a long-term bull, such as yourself, look at India more favorably in the near to medium term? What would make you turn confident from cautious once again?
Look, I think it's really a function of how the earnings growth is coming through, because I try not to make big political calls in either way. In fact, some of the best opportunities are when people are nervous, right? I mean, if I look at my own record, 2013 really built the next 2 years record because we actually bought hand over fist, right? People are nervous. So I personally like little bit of shakeouts because then somebody's giving things to a much more attractive valuation rather than when everybody's positive. That historically that's happened. 2004, the election scare, and so on and so forth. I mean, even going back to the 90s. So I think right now there's a little bit of complacency, and within that sort of market structure, which is impacting because some of the larger defensive growth is struggling a little bit. Now they may turn around, and I'm obviously I like to remain objective and happy to go back and look at some of these things. But at this point, I feel that the earnings growth is going to struggle for significant portion of the index, and a lot of money is coming in, by the way, right? So in the local mutual fund, which is obviously has to go into the domestic capital markets, which is obviously supporting and let's not forget, I think it's relative, right? So I still have 10%, which is actually my marginal overweight compared to the index. It doesn't have 25%, but I think there you do need some compression in valuations for it to get intriguing again.
And finally, before we leave, your new venture with GQG Partners and the new fund that you've come out with, which is the GQG EM Strategy Fund, which has raised about $1.5 billion. What is the strategy with regards to managing money in this fund and generating returns?
So yeah, there's no difference in strategy. We are still managing institutional money. We currently have around $1.5 billion under management, and we should have between $3.5 to $4 billion by end of this quarter, sort of confirmed money. And it's global as well as emerging markets, like I did at my prior shop. So it's again higher quality businesses where we feel the business will be getting better on the next 3 to 5 year horizon, and relatively concentrated.
Well, Rajiv, I'll have to leave it at that. Thanks very much for taking out the time for this very special interview. I appreciate your insights as always. Well, with that, we come to the end of this edition of the India View with Rajiv Jain. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.